Hi, I'm Debra from the Property Frontline.
Hi, I'm Ken from Avvora Finance.
And I'm Gilmovich from Real Property Manager. And welcome again to next edition of Property Mythbusters, where we bust some myths around all the contradictions and misleading information in property buying and property investing space. And we're going to be debunking the myth around that price, when you get negotiating price, is the only thing that you can negotiate when you're buying a property, renting one, or taking out a loan to purchase. Let's take a look on the rental side of things and what landlords and tenants can negotiate, or what tenants can negotiate with their landlords. So what else can we negotiate as tenants with our landlords or property managers? Well, the first one, of course, is the length of your lease. And pre-COVID, when the market was very tight, there was some inflexibility around sort of lease lengths. Property investors like long tenure, obviously to avoid rental vacancies and, of course, increase in reletting costs. So they used to be pretty fixed on long fixed-term leases, but the market of late has given flexibility to negotiate much less tenure. 6 months, if you're willing to sign up for 6 months, and that's what you want to do because to have some flexibility. You'll find that today's market that landlords are willing to do that in order to fill their property and avoid continued vacancy rates, which are high at the moment. Okay, the second one is the moving in date. Now, there'll be pressure from the landlord to get you in there as soon as possible, especially if the property has been vacant for a while. So normally the tolerance level is to get you into the property between one and 2 weeks. But of course, that might not work for you as a tenant. You need to move in a bit later, and 3 to 4 weeks, sometimes up to 5 weeks, depending on the overall negotiation. Sometimes the landlords are willing and able right now to be flexible on the moving in date. And of course, that gives you a bit of ease in relation to having to pay double rents, especially if you're moving from another rental property and still paying rent on your current property and not having to pay rent on your new one. That's definitely a point of negotiation right now. Another thing that comes up is the pool and garden maintenance, and this is particular in rental homes. Now, traditionally, pool and garden maintenance has been embedded into leases as the tenant's responsibility. But now, because of a different marketplace, there is some negotiations on that front, as well as flexibility. And I have seen and have negotiated leases whereby instead of the tenants paying the cost of that, the landlords subsidise the cost or include it as part of the overall rental figure. And that gives them some control over the actual gardening process and the pool and maintenance cleaning, where they're happy that it's done and it's done properly and it's done regularly and it's not neglected, because it is a hugely neglected area of tenancies where things go wrong, very badly wrong. Cosmetical changes, or what we call alterations or minor alterations of premises. So things like, can I repaint a different color, or can I give the property a fresh coat of paint, or can I install some extra safety locks or picture hooks, comes up as a point of negotiation from tenants. So again, the tenancy legislation is on the side of the tenants in this case, and the legislation says that minor alterations to the premises should not be reasonably refused by landlords. Landlords and their property managers are willing to negotiate those things, and my advice to any tenant is to negotiate that before you sign a lease and not after, where that comes up as a surprise. Do it up front before you accept the tenancy. Rental increases, of course, is an interesting one, and some landlords, because given the current rental environment, both on commercial and residential front, that rental increases in residential are not, let's just say, not welcomed with arms wide open right now. It's not a market where rents are rising rapidly, and the same thing with commercial. For example, commercial shop fronts that, the landlord has this kind of old world mentality that they're going to embed, 7 to 10% rent increases each year on year. Well, that's just not going to work at the moment, given the low CPI environment. CPI sits around 1.2, 1.3%. So how can you expect a commercial tenant running a business to have year on year, 7 to 10% increases? The same thing with residential. Residential rents aren't rising at the moment that rapidly. Well, not in the inner city markets anyway. You don't have to accept, excessive rent increases during this market. So there's flexibility around that right now, especially on the fit out periods on commercial properties. For example, you've got the bare bones of a shop, and you need to fit it out for the purpose of, let's say, a coffee shop. Well, you're going to need time, leading time into that, and what we call fit out periods or rent-free periods are up for negotiation at the moment. So that kind of helps you with cash flow, and that you're not paying rent, the market rent, right from the get-go while you're actually establishing your business. So there's definitely flexibility and negotiation around that. The very last one, of course, the great debate of pets in rental property. I know that for a fact that a lot of tenants get discriminated around the keeping of pets, whether it's inside an established freestanding house or of late strata property has generally, and owners corporations have generally declined the keeping of certain pets, and especially dogs. But those laws have now been relaxed, and especially a landmark case which happened last year has opened up the opportunity for tenants to now keep cats and dogs mainly inside of strata property, where the owners corporations can no longer have any what they call harsh and unconscionable bylaws that blanketly say that you cannot keep one. So those laws are now relaxed as a result of a very landmark case last year inside of a strata building. So there's a whole heap of items you can negotiate on, and get yourself a win-win if the price is not part of the negotiation.
Okay, great.
So,
I'll have a chat about home loans then, in terms of what are some things to look out for when negotiating. So firstly, not all lenders, when you're looking for a home loan, will be open to negotiation on the interest rates, because that's usually the primary cost that everyone's focused on. But there are also other costs to consider, and sometimes even opportunity costs to decide whether to kind of, choose one lender over another. So the first thing then would be, when I meet with clients, usually the first thing would be, we're looking for a home loan, a lender who will likely approve the loan, or who will not reject the loan straight out. So that's probably the first thing to be looking for, because if you are looking for something that's the absolute cheapest in the marketplace, you may find that you can't get the money that you actually need, or you need a substantial deposit. So there may be conditions that you don't necessarily meet to get that particular interest rate. So once we've got the list of lenders approved, it's quite easy to kind of then identify which lender is going to be the most competitive from the panel of lenders that I've got, 30 over lenders. So some of the things that you can kind of look at is the types of options that they have within the loan. So some lenders have a Medico policy, or a policy which targets particular professions like accountants and solicitors, specifically, where you can actually borrow, 90%, 85%, however the amount is, and not pay lender's mortgage insurance, and that could be a savings of a substantial amount. And that needs to be factored in, I guess, or weighted against, what's the cost of the interest rate by this lender, plus not paying lender's mortgage insurance versus going to another lender, paying lender's mortgage insurance and having a lower interest rate. I'll throw in there just real quick. If you are looking at interest rates, you'll probably find that when lenders are advertising interest rates, they also have a comparison rate. So the comparison rate just kind of includes costs, application fees, ongoing fees like annual package fees and things like that into the product. So you can kind of see, you can gauge whether there's a lot of fees included in that particular home loan. I won't go into the calculations in terms of how that works out, but it is a very good yardstick to kind of check to see if one product is more competitive than another. The other thing would be whether the loan product gives you the options that you're looking for. So when going back to the approval first point, if you are buying a house and land package, not all lenders do construction loans. So it might be an idea to, well, you would need to kind of identify a home loan that does offer that feature. Otherwise, you might find that you kind of come unstuck when you're trying to proceed with the purchase and the construction's going through, and you're finding out that the lender doesn't actually cater for house and land packages or constructions. The other thing would be, and more recently, this is kind of going to opportunity costs, whether you pay lender's mortgage insurance or not. Sometimes, I speak to a lot of first home buyers who are averse to not paying the lender's mortgage insurance cost. And it could be a substantial amount. It could be, for $600,000 property, could be on par with stamp duty, about $20,000. But it does depend on whether you want to kind of put out that amount of savings or deposit to bring your loan to value ratio down so you don't have to pay lender's mortgage insurance. I'm finding that a lot of first home buyers tend to prefer to keep some cash in reserve. Maybe they might not pay the full, lender's mortgage insurance. They kind of pay a little bit. So they increase their LVR and pay a little bit of LMI. So that's something to consider as well, because that could be then savings to purchase a new investment property or other investments. So there's opportunity costs there as well. And the last thing would be borrowing capacity and timeframes. So, with the speed of the market, the speed at which the property market's moving at the moment, which I'm assuming Deb's probably going to touch on a little bit. The one, making sure that you've got enough borrowing capacity to hit a price bracket that you're interested in. Once again, a lot of first home buyers seem not to want to stretch their borrowing capacities, which is prudent. When they go out there to find property, they kind of realize if they had an extra 20, 30,000 in terms of the loan amount, it pushes them up into a different price bracket. And that's, it kind of ticks more of the boxes of the properties that they're looking for. So borrowing capacity is one thing, and it may mean that the interest rate is not as competitive. So there's a bit of a, pro-con analysis to see whether, you do want to pay a little bit extra on your home loan to get a higher borrowing capacity. And the other one is timeframe, so speed. At the moment, most of the majors are running a bit slow in terms of turnaround times, and I'm starting to see now the smaller lenders are also struggling a little bit. They're nowhere near as bad as majors, but they're starting to see an influx in applications and things like that. So timeframes is also probably something, not necessarily that you can negotiate, but something that you can factor into choosing a home loan, because that can play a part in whether you're able to, attend an auction or, bid on the property before it gets off the market. Those are the kind of opportunity costs, because if you're waiting, 6 weeks, 8 weeks to get your loan approved, where's the property market going to be at in that time? I'm not saying it will go up. It could stay flat or decrease in that period of time, but, have a think about what you think the cost would be to actually wait that long before re-entering the market. It may not even cost you anything to do so, but just a thought, food for thought. So that's everything in the home loan space in terms of, not necessarily zeroing in on the interest rates. Deb, what's your take on this with purchasing property?
Thanks, Ken. That was great. So I've taken a dual approach to this topic. In relation to using price in negotiation, there's an aspect of how you'll make your offer more attractive. So in a hot market, you want to offer other things other than price to be able to, have your bid accepted. And the other side is to make sure that you're protecting yourself and making sure that you're getting the most out of the purchase. So how to make your offer more attractive? You could waive the cooling period or basically make an unconditional offer. So in New South Wales, we call this a 66W offer, in that it means that you won't have the opportunity to, do a deep cut if you want to wait for your finance. So if finance is approved already and you've already checked out a building and pest inspection that might have been on offer or a strata report, then you might want to just jump in and offer to buy that way, buy really quickly. So you can negotiate on a longer or shorter settlement. Now this is where, when you're looking at your property, it's important to gather information about what's important to the vendor. I'll say a standard contract, you might be looking at, say, a 42-day settlement period before the property becomes yours. It might be that the vendor, the person who's selling the property, might want longer. And so it's around about asking these sorts of questions of the agent to find out what would be attractive and, adjust according to what the vendor wants. The other point that we actually negotiate on is making the funds, so your deposit funds, available during the settlement period to the vendor. So if we know that a vendor is looking to sell their property and buy something else, they would want access to the deposit funds so that they can actually use that to put down their own deposit on the next purchase. And so, we'll pick up that kind of information along the way while we're assessing a property, and then when we're making an offer, we might include that. But of course, it does come at a risk, and you should talk to your solicitor about whether this is a good or bad thing, because, it could mean, though it's never happened to me, it could mean that the vendor might take off with the money and you might have trouble accessing that if you crash the deal before settlement. The other thing that we try and negotiate on is unique items. So I actually once had a family that wanted the dishwasher from an old house. It was an older dishwasher. It was just sentimental value, but it was about paying attention to what that particular vendor needed and saying to them, well, we're happy for you to take that. We didn't want it. And, other items such as custom curtains or just pretty much anything, just really what's important to the vendor and offering them the opportunity to take that with them once the sale has settled. The other thing, in a hot market, you might want to do things like offering to cover their removalist fees and just thinking a little bit differently to provide extra little incentives. And then finally, it can really be anything. So it's really about collecting information about the vendor to make the offer really attractive. Now, this next point is a little bit controversial, but really, property is an exchange between humans, and one of those participants is the agent. And we've got a scale of much more professional agents these days, but there's still an element of self-interest there. And so you do have to understand that the agent does play a part. If you're dealing with the agent putting in your offer, then they have to present a number of offers to the vendor. They're going to be a little bit biased as to presenting those offers. They shouldn't be. A professional one wouldn't be. But anyway, so you just have to understand that the agent is part of that offer process. So one of the things you could do if you're buying and also want to sell, you could consider using the same agent for the sale of your property. So, I won't go into the detail about that. It's sort of a little bit controversial. But the next point is very important. Really, you're dealing in a professional and fast-moving environment, so you want to make sure that you treat the agents with respect, be honest and transparent. You don't have to play games with them. You can rest assured they've seen it all before, and so the more upfront you are with them, the more they will go the extra mile to help make the deal happen for you. Ensure you're organised and respond to the agent's requests and reasonable requests. And make sure that you are organised. Have your finance approved before you're ready to make an offer, and make sure that you've reviewed the contract, blah, 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 and make sure you explain that to the agent and say, this is what we've done. I'm pre-approved. I've got nothing in my way to buying this property. Now, on the other side, to make your purchase more successful, so thinking about your own interests, things that you can negotiate on apart from price are the cooling time frame. In most parts of Australia, we'd be looking at anywhere between 5 to maybe 14 days of a typical cooling period. So you negotiate the price and would sign the front page of the contract or a particular page of the contract, depending on the state. And then you have a period normally to ensure that you've got your financing organised and approved, and give the bank time to value the property, because even though you've got pre-approval, the bank still has to be satisfied that you haven't overpaid, so they want to value it. Also during cooling, if you haven't been provided with a building and pest report and strata report, that's when you commission those reports and inspections and review the results, and just conduct further due diligence, particularly that's particular to the property. So it might be checking out some council zonings and building approvals. So the other thing would be percentage deposit. So standard contracts mainly will ask for 10% deposit. It's really common practice to go for 5%, but you can chance your arm and go as low as you possibly can. And then also the settlement period. In a similar way to the vendor, how I was saying, like they might like a shorter or a longer period. You as well it may be important for you to have a longer settlement, but think about these types of things. I was just about to say, in a hot market, you can make it subject to valuation. But really in a hot market, you just have to be as flexible as possible. But we do use this quite often. We just make sure that we've got a bit of flexibility in relation to the banks. If we're buying in areas where we think the bank might be a little bit soft on, like they might not agree on the price that we've paid. So we might say we want the sale subject to approval by the bank's valuation.
One thing I might mention as well, throw in there while you're on the topic of valuation, because from a broker's perspective, like that valuation process is a little bit, we're always fingers crossed to kind of hope that it comes back on target. It's beyond our control. So they have a panel of lenders who do the valuation and then they come back. One thing I was wanting to mention there is that to kind of make evaluation a non-issue is not to borrow near key LVR thresholds. So if you're like at 80% because you don't want to pay lender's mortgage insurance, if the valuation comes back short a little bit, you might find that you end up having to pay lender's mortgage insurance. Also, the absolute caps as well, like investment loans are generally capped at 90%. So if you're like literally riding that threshold on 90%, and it comes back lower than expected, you'll probably find you have issues. And also if you're borrowing right at your limit, like you actually need a particular loan amount with no buffers, you'll find that that's an issue as well. So if you do have, if you are flexible with the LVR moving, because if your financial position supports that, then that's always ideal. Just reduces the chance of evaluation causing a show-stopping event. So that's something I thought I might mention.
Yeah, that's good. The other point is to ensure your solicitor reviews the contract and adjusts, key technical items in the contract. Like anything in the contract can be changed. It is really, I'm always surprised at how so many buyers, without advice, will just buy and not have a solicitor review the contract before you sign it. Not during the cooling period, because you have less leverage then. Anyway, so the other thing to think about is changing some more clauses. So things like use of campaign photos, so using the sales photos for advertising, and also being able to advertise for a tenant before settlement. With the building and pest inspection, now there is a time frame for when you would do this, but if you get agreement on price, you do your building and pest inspection and you find out that the roof is an absolute mess and you need $10,000 to cover that, then you can go back. It's at that point that you would then negotiate the price down. And there's a lot of variations along there. The other point that we always negotiate on is early access. So accessing the property prior to settlement, really for the purposes of just measuring up. My advice is that you don't conduct substantial work until after settlement. And then the final key point, once again, if there's a property that you love and they've got this amazing barbecue area out the back, you can negotiate to include extra items that would be hard for the vendor to take out and will increase the value of the property. Alrighty, so that is pretty much us. So thanks very much for watching. You can reach any of us at our main sites. So John at realpropertymanager.com.au, Ken at avvora.com.au, and me at propertyfrontline.com.au. Thanks for watching. Bye.